Welcome back. The market continues to be in the doldrums, really. We are still looking at losses of about 73 points on the Nifty right now. And you can see there is absolutely no sign of recovery that's coming in. Every time there's a slight bounce, it gets sold into again. So it's that kind of a day after a 50-point decline yesterday. As of now, no sign of stability. The mid-cap index is down 1%. The bank Nifty is down about 300 points. Rohit Shrivastava, fund manager, PMS of Sharekhan is with us on the show today. Rohit, good morning. Thanks for dropping by in the studios. So obviously there's a lot of discontent, fear, panic, particularly with what's happening in the NBFC space and with what's happening to certain financial groups and conglomerates. Now, what sense have you made of the events around DHFL, Indiabulls? Is this a contained problem that should be limited to these stocks? Because right now the whole screen is painted red.
Okay, so there are two ways to look at it. One is, of course, that you would like to think that it is contained because what you hear is only a handful of names. But the way that I have studied this problem over the years, and I've discussed it more from a long-term cycle perspective, is that you are in a state where India's debt equity has really been going up, and rather than say debt equity, I should say debt to GDP. Okay, and on the one hand, if you look at a 10 to 15 year time horizon, the government has actually been bringing down its debt to GDP ratio. So it had hit almost 90% in say 2002, and today you are at around 64-65% maybe, and the total debt to GDP though, which is for non-government, would be closer to 160-165%. So that means you're saying that almost 100% debt to GDP now is non-government. And the reason is that as the government has pulled back, which is exactly what they would tell you to do, that during a growing economy they should always tighten. That gives them a lot of room to expand when things are difficult, which is the situation we face now. But that entire burden was taken on by, I think, the private sector, which is why you've seen NPAs then followed by NBFCs. And I think as long as the economy keeps slowing and you don't have a turnaround, you will get additional such problems popping up from time to time. There may be new ones that we've completely not heard of or thought of in the future. And that's how I really look at it from a macro perspective, because you may not be able to really point it out that this is the next shoe to drop. But if you have it in your mind that shoes are going to drop, then they are going to drop in the future, because that's the long-term cyclical nature of the market. Now the question is, how do you come out of it? You really want growth to come back, and the answer to that is that as and when you have a crisis, the government will have to step in and start spending. I think there's no shortcut to it, but the problem today is that when you're at a peak market level, will the government at its current fiscal deficit and existing demands be able to really step in at the magnitude that is required to change the scenario? And that's where I think doubts are arising as of now, but eventually I think they will have to do it. I don't know whether it happens 6 months or 12 months down the line.
So you're saying that we need a stimulus basically?
There's no other way. There's no other way.
But what about this, the debt issue, just to come back to that? One is, of course, growth will take care of a lot of problems. But immediately we seem to be having a meltdown in many of the financial services firms.
So the reason for that is that people are not able to see that stimulant come in right away. Okay, so if you're looking forward to the budget, you would want them to come up with a spending plan, maybe spend 100,000 crores over the year, and yes, definitely that boosts numbers. But then, do you have that space? Okay, so you don't have that kind of space.
My question was more limited to whether specific interventions are required to
contain this problem?
Contain this specific problem.
It would be, but taking decisions to specific corporates is always difficult for the government, because if they do something for one, then they need to do it for all. So it would come down to favoritism, and that's where they will always hold back till they're solving a larger problem. It's like the too big to fail problem that you faced in the US, say 10 years ago. I think it's coming down to the same thing. Who are you going to save? Who are you going to put the money behind first? So I think first it comes PSU banks, which they are already committed to. Okay, and they probably need to commit some more over time. And so that's, I think, the first one which is very clear. Now in the private space, who are they going to commit to and who are they not going to commit to?
So can I use that logic to say that till the time the problem reaches the doorstep of a bank, right, should not expect action?
Yes, that's one way of looking at it.
And that to which bank? private sector banks, PSU banks. So that's again a different question mark. I'll talk about the other leg of the stimulus that one keeps sort of hearing a lot of demands around, which is monetary. And one keeps hearing calls for more rate cuts, more aggressive action from the Reserve Bank of India. But is that really going to solve anything? We've already seen 75 basis points of rate cuts in the last couple of months. Transmission has been very slow, but B, generally speaking, that doesn't seem to be taking care of some of the issues which are more fundamental in nature. I mean, the fear psychosis is in the mind. Demand is not picking up. Do you think that more aggressive rate cuts can really stimulate demand?
So that's a good question, and I think you partly answered it with the words fear psychosis. So what really happens in an environment where debt levels are high and you start unwinding is that everyone gets scared. Okay, and fear is the first reason why banks stop lending. So if you go back, last couple of years, you see the credit growth actually petering out and was almost down to zero. Then it did pick up a bit in between. The reason that happens is once people get scared that if I lend and it's going to be a bad loan and they stop lending, so your money supply actually stops circulating. So that's the first level problem. The second level is now as the NBFC problem has cropped up, even when you cut interest rates, you're really seeing spreads which is between the government 10-year and the actual lending rate at which a lot of the private borrowers are borrowing actually expand. So if you look at the credit spread on Bloomberg, you've seen that expand over the last 6 to 8 months. That's again a reflection of fear. So when fear is high, people are not going to close those deals. So will rate cuts work? It will work for the government. Definitely the government gets to borrow at a lower rate. Okay, but do private borrowers really get to borrow at a lower rate? And that's where intervention really will become required, I think, over a period of time.
So where does this leave us on the market? Let's just distill it down to, because you look at technicals as well.
So it's a risk. I think the risk is pretty high, not just in, and so that's where it becomes global also. I think a lot of hope was built behind the election season, and that played out. Markets went up even while the world markets were actually down in May. Now, most world markets are actually bouncing back from that initial sell-off which happened on the back of trade wars. But I think a large part of that bounce may be sort of complete, and you might now again see a further weakening because you're going to get an earnings slowdown, not just in India, but you're going to get it in US also. I think this quarter is going to be one of the worst quarters for US earnings based on the data that I'm already looking at. And so that's going to push, I think, everyone. Even US is talking about stimulating by rate cuts. We're also talking about stimulating by rate cuts. But history of it shows that rate cuts are a process. It's not that one rate cut solves the problem. It's usually in the US the study shows it takes at least up to 400 to 500 basis points of cuts before they've actually had a turnaround, either after the 2000 recession or after 2008. So we are here. They've just raised rates and they need to cut a long way. They would probably start. Will the first rate cut work? Then you'd see that, okay, is it working or not? Then you get a second, then you get a third, then you get a fourth. So it's a process.
But that is only once you're already in a recession that you need to cut by that much, right?
That's right. So you're beginning to reach where you're in an earnings recession. You probably still don't have a GDP-based recession because you're not seeing negative growth, but you're definitely seeing slowing of growth. So even in our case, we are seeing slowing of growth. We are hoping that a rate cut will actually solve the problem. But if it does not, you'll get a second and a third and a fourth, and it'll take a series before you actually get a turnaround. So you have to give it that much time.
I guess we can only wait and watch till then.
Put some levels though.
On the index, if you can.
So the upside that I was keeping for a while, which I'm not seeing now reach based on today's market action, was around 12,180. So that's like the risk to the upside. On the downside, I think today's break signals that we might be now heading towards 11,400, 300. Okay. And in terms of Bank Nifty, we could be looking at around 29,300. These are going to be the first most important support levels on the way down. If those break, then it's mayhem from there. But that's the first major level that I think we go to.